Hello, everyone. Welcome to Real Estate Right Now. We talk about real estate matters that matter to you. My name is Jay Izzo, and we are live here from Linda Craft Team Studios here in Raleigh, North Carolina, part of the Greater Research Triangle Park. Today's show. You know what? If you've been on Zillow lately or some other places, you may be feeling like the dream of owning a home in the Triangle is slipping away, no matter where you live. Stop scrolling and just listen here for a second. We all see the headlines. I get it. High prices, high rates, and the myth that you need like some sort of mountain of cash just to get your foot in the door. But the headlines are missing the real story. The truth is that there are, wait for it, cheat codes to the housing market that most banks don't advertise. There are programs right here in our state, and probably with your state too, designed to help you buy a home and where there's little to no money down, and if you know where to look. So to help us crack the code, I brought in our code cracker, Christopher Coy. There's a lot of C's in that, by the way. Christopher Coy, he's Vice President, Senior Mortgage Loan Officer at TowneBank Mortgage here in Raleigh. He's been serving for over 17 years of experience. He's done more than $700 million in loans, secured for local families. He knows exactly what it takes to get an offer accepted in the market. So Chris, welcome back to the show.
Thank you. Appreciate you having me.
It's great to see you. You've been on this show before, and when we were coming up with an idea for this show, we talked about, a lot of times people don't realize that they can get into a house, and because, there's been all this talk in the media, and I am part of the media, but I don't trust most of the media, even being part of it, because we don't get the whole story. And which is true in this case. We didn't get the whole story. We have people who are saying it's hard to get a house. And I'm not saying it's easy, but I am saying, and after talking to you, that there isn't as big of a barrier to entry necessarily that you think of getting into a new home.
I agree with that. And most of the customers I speak to come in with an expectation that there is much more really out of pocket, if you will, the money they would need to come up with to make it even an option.
Right.
And it's been ingrained in most people going back to when they were really little from their parents and their grandparents generationally that you need to have 20%, you need to have 20%. And happy to help you understand why that's not necessarily the case. And the environment's a little bit different. So the reason for that direction is even a little bit different.
All right, so let's jump right into the 20% down myth. Well, might even be a flat out lie that that's probably the biggest barrier that people think is that most people who are renting right now believe that they need to save 20% down, which on a $400,000 home would be about $80,000, and they feel that that's just impossible to do. Can you walk us through the math of why that's false, and what is actually minimum down payment someone needs if they want to get in a home today?
Absolutely. So at 20% down, $80,000 on a $400,000 house. To that, you would generally need to add some closing costs and funding your escrow account and such. So that $80,000, when people go to the internet and do the basic math about that 20% down, it could be more than that 20% down. It could be more than the 80,000. It could be closer to 90, 95,000 total out of pocket that they would need to get in that house.
Right.
And you're exactly right. Cash to close, coming up with that money is the number one barrier to entry for most people getting their first house. So you don't really need 20%. That 20% that most people were conditioned to think you need came from either their parents telling them that or their grandparents telling them that, someone coming from someone else who had bought a house from a different period of time. As an example, the mortgage interest rates between 78 and 1982 were anywhere from 12 to 22% interest rate. So if you didn't put 20% down back then, it was basically like loan sharking. You had this monster payment, and it did make complete sense that you need at least 20% down in that environment. Now, when you fast forward to 2026, And look at the mortgage environment where the interest rates are now. Yeah, the interest rates are above where they were a couple of years ago, but the interest rates at roughly high fives, low sixes right now are still well under the 40-year average of around 9%.
Right.
So the cost of capital or interest at this point is a lot better than it used to be. And at the same time, the myth about that 20% down is if you don't put the 20% down, you're going to have mortgage insurance. And it's painted like mortgage insurance is some horrible, horrible thing that you have to pay if you don't have that money. But it's not necessarily a bad deal. It's actually a really good deal. Someone on that $400,000 purchase price, instead of putting 20% down, might be able to put 5% down.
Right.
And in this environment, now that we're closer to what we call a balanced market, not just a seller's market, it's a lot more common for people to have access to potentially some seller paid concessions or a reduction from the seller to allow them to offset that cash to close. So with 5% down and a small amount of seller concessions, you can get into that house with, significantly less than, $90,000, $95,000. In addition to that, the penalty for not putting the 20% down, having to pay that mortgage insurance, most people think it's, $200, $300, $400 a month. But if you have really good credit, and mortgage insurance is extremely credit score sensitive. If you have really good scores in the mid 700s or higher, mortgage insurance can be almost nothing, meaning $89 a month or $100 a month. So to save putting down or not have to deploy 20% towards that $400,000 purchase, instead just deploy 5%, $20,000. That allows you to hang on to $60,000 that you normally had to put in there.
Right.
And if the mortgage insurance payment, by going to a 95% loan instead of an 80% loan, is only additional $120 a month, you basically, for $120 a month, you can hang on to your $60,000.
Right.
So now you can take that money and use that to pay higher interest obligations, cards or other debt, or you can leave it with your financial advisor. If your financial advisor can't figure out how to make you $120 a month on $60,000,
change your advisor.
You need a different financial advisor. So,
get rid of your advisor.
And it's not that I'm suggesting people are highly leveraged in their house.
Right.
I'm not suggesting people are house poor, that they have this big payment, but there's a big difference between having $60,000 with your financial advisor kicking you a couple $100 a month in interest, and then having the obligation over here. That's very different than not having, $50 put away for a rainy day fund for emergencies. It's very different having the money over here with your financial advisor and then having an obligation over there. Worst case scenario, you can always take that money from your financial advisor and send it in and pay your loan down. So, a lot of people, when they go through the options, when they come to me prepared after all of these years of hard work, we're finally ready, Christopher. We've got the 20%. We're ready to do it. And then I show them, okay, well, this is exactly what it looks like. Just a heads up. You could also put this much down and have a slightly different payment. Is that of interest to you? And it's amazing, 99% of the time, the people are like, wait a minute. So our payment's only a little bit more, and we don't really need to deploy all of that money. And it's generally a welcome option for them to move in that direction.
Okay, so you brought up credit scores, and there's this perfect credit fear that exists out there where people are almost terrified to even give you a call because they don't have this 800 credit score. So be honest, what's the real world credit score floor? And if someone has a 620 or 640, does that mean they're out of the housing game?
Not at all. Not at all. In fact, there's a lot of great programs out there that don't penalize the buyer in that area. An example of that, I think you mentioned earlier, some of the down payment assistance programs, such as the North Carolina Housing Finance Agency options. There's actually no benefit in their program for having higher than a 640 credit score.
Yeah.
So the sweet spot is really around the mid 600s. Once you get to a 640 credit score, particularly for a first-time home buyer, that's when the options really open up to be able to get into your first home with little to potentially nothing out of pocket. So a 640 score will get you in the game, and it just gets better from there. I'm not saying that, if you had the option to go into battle with a 740 credit score or a 640 credit score, yeah, of course you're going to choose the 740, but those options will be slightly better. But when you weigh in renting for another year or two,
right,
or getting in and allowing that house to potentially appreciate and have all of the benefits of the home ownership for that period of time, very quickly, you'll see that the ownership will outweigh the waiting piece.
Okay, so you brought up some North Carolina programs. There's one program that TowneBank participates in. It's called the North Carolina Home Advantage Program.
Yep.
And how does that work? I've heard that there are options for $15,000 in down payment assistance that acts like 0% interest loan. I don't know if that's true or not. How actually does that? Who actually qualifies for that if that's true?
Sure. So the North Carolina Housing, the NCHFA First Advantage Program, that's a program that allows $15,000 in down payment assistance money that the program gives to the buyer towards the transaction. That $15,000 is interest free and payment free forever. So it's like me saying, Jay, here's $15,000 towards your transaction, so you don't have to come up with that money. I'm not charging you a penny of interest on it, and there's never, ever any payments due on that. And if I don't ever see you again, the money's forgiven. Don't worry about it. But if I see you in the next 15 years and you insist on paying me back, I will only take back exactly the $15,000 I gave you, not a penny more.
So there's no interest.
There's no interest accruing on the $15,000.
And they don't even demand payment back for it.
They don't even demand payment back. The only way you can pay them back is if you insist on paying them back by either refinancing the loan or selling the house. So the only way you would have to pay them back was if you tried to sell your house.
If I literally went to you and said, Chris, I really want to pay you back.
So you can if you want to, but there's no upside to it whatsoever.
So, but when you sell the house,
that would just be that $15,000. So it is slightly more detail oriented than the way I'm explaining it. And the easiest way to explain it is that $15,000 is treated very similar to a 401k vesting schedule. And instead of it being between the first and the fifth year, that money is actually forgiven back to the first-time homebuyer, that borrower, between the end of the 11th year and the end of the 15th year in 20% increments. So if you keep that house and that loan for 11 years, you only owe 80% of the $15,000. At the end of the 12th year, it's 60%. At the end of the 13th year, it's 40%. At the end of the 14th year, it's 20%. And at the end of the 15th year, you owe zero.
So it's basically $1,000 a year almost.
It's just free money. So you can either use their money towards your down payment, or you can use your money.
Who qualifies for this?
So anybody that has not owned a primary residence within the last 3 years. It could have owned another home.
Right.
As long as it was documented as not a primary residence. And as long as your credit score is over a 640 minimum credit score. And there is one other obligation on that. That other obligation is your qualifying income for that program can't be over the county limit. And in most counties in North Carolina, that's roughly around $145,000, which is a good amount of money. So it's pretty easy to qualify for the program, and people are doing it all day, every day.
And they don't know, and I don't think there's a lot of people who realize that that's even available to them.
You're exactly right. I take phone calls on all day long with people worrying about how they can possibly get in the house. And then when I show them that, it's a very welcome option that's out there to find out that they can do that. So, and every day I have people come to me that don't necessarily have to go that route. And then when I show them that route next to the other option of using their own money, most people can find a better place to deploy their own money to get a better return than the cost of this money. So, yeah.
And that leads me to another thing I read about TowneBank. They're a member of the Federal Home Loan Bank Network.
That's correct. So,
and, which is grants specifically for community partners, like educators, law enforcement, healthcare workers. Are there grant funds available right now for those people? And is it true they don't have to pay that money back?
So the answer is yes. So us being in North Carolina, we're part of the Federal Home Loan Bank District of Atlanta. Okay. So in the Southeast, if you're an FDIC or community bank domiciled in that footprint, you can be a member potentially of the Federal Home Loan Bank of Atlanta. When you're a member of the Federal Home Loan Bank of Atlanta, that Federal Home Loan Bank has certain funds that are periodically available to buyers in certain areas. In North Carolina, I will say that here at TowneBank, we have both the Federal Home Loan Bank money as well as the North Carolina housing money. And most of the time, the North Carolina housing money is a better option, and that's usually the first option chosen. The Federal Home Loan Bank money can be a little bit more difficult because it rolls on and off for availability. The Federal Home Loan Bank money, they can run out of that money. And even though you can be approved for that program while you're looking for a house, it is possible that right as you find your dream home or your first home or the home you look forward to moving ahead on, it is possible to find out that those grant funds have been depleted and that it may be another period of time, couple of months, quarter, could be longer before that money is available again. So though the Federal Home Loan Bank money is a great option and it is out there, it is a little bit less consistent and a little bit harder to move ahead with if that's your only play to come up with the money to get in the house. So
you said something here, or at least alluded to it. You didn't say it, you alluded to it, that I couldn't do both. Is that correct? That I couldn't do both the North Carolina and the federal home. Is that true or not true? Or
that's a great question you're asking. And essentially what you're asking is something we pride ourselves in being very good at. And I call that the stacking. Okay. So can you stack a down payment?
Right.
And yes, in certain situations you can.
Okay.
But the asterisk or the but next to it is each one of those programs is going to have qualifiers and disqualifiers. Some can be laid over each other and used together, and others you may be overqualified for, or they may not lay together in certain areas. An example of that would be TowneBank as a community bank in our footprint. We have certain CRA, Community Reinvestment Act, areas where we participate to give back to the community. So in addition to, say, either the $15,000 First Advantage down payment assistance through North Carolina and the Federal Home Loan Bank money and other monies that are out there, TowneBank also has directly from our own coffers, TowneBank has $2,500 in addition to that I can provide in the transaction to help the borrower have less out of pocket, less cash to close, less money needed for them to get their first set of keys.
Got it. So stacking is possible, but there's a little trickiness to it.
And I'm happy to talk about it. And I could sit here and just say yes to everything, but
well, I don't want you to do that because we want to be honest.
There are situations where it does all fall together and work perfectly.
Right.
It's always best to have the conversation and me hear what the borrower's trying to do, and then lay them all together and show the customer what ones would work for them. So yes, you can stack many of the different ones and put them together.
Okay.
You can do that.
So there's some great possibilities here. I'm going to move to those of us who are self-employed.
Yeah.
Because in the triangle, we have a bunch of freelancers and gig workers like me. I mean, I'm a freelancer. I'm a kind of an entrepreneur. I guess I am an entrepreneur. I have, all
Absolutely.
sorts of, I have all sorts of things going on, work for myself. If I don't, which I don't have a standard W-2, how does TowneBank look at my income, and what documents should I have ready before I want to purchase a home so I don't get rejected?
That's a great question. There's no way for you, for the most part, other than trying to, scour the internet and figure it out and then come up with a bunch of information that's not accurate.
Right.
The best way to figure that out is to call a lender, someone you trust and confide in, and share with them your situation to hear the options. So an example of that would be TowneBank has phenomenal offerings. And also, to your point, there are many, many people that are self-employed. And I call it the self-employed conundrum. The beauty about being self-employed is
you're self-employed and it's free. Freedom. It's so much freedom for us, right?
Potentially, you don't have to pay a tax obligation if you can, work with your accountant and have things laid up perfectly. It's possible that you have actually no tax obligation. The downside to having no tax obligation is potentially your taxes show that you have no income that has a tax obligation. So the old catch-22 is that you're self-employed and you don't have to pay taxes. The downside to that is you're not showing income to qualify for the loan. So that's only through the normal basic vanilla channels, if you will, that you would be showing your taxes and using your taxes as, the net income on your taxes as qualifying income. So there's many, many ways around that. Okay. An example of that would be, we have what's called a bank statement program. So as a self-employed individual, you may be phenomenal at what you do. You may have your gross sales might be phenomenal, but you're also able to write off a huge amount of expenses, which end up zeroing that out. That, from a tax form perspective, may not show much, if any, actual net income that's documented that you owe taxes on. But we have programs that will allow you to take just those gross receipts, as simple as that, gross receipts into your bank account, potentially your personal bank account, potentially the business bank account, and basically just divide those over a 12 or a 24-month period of time and use that as documented income. So it's not uncommon for someone self-employed like you to, instead of working with your accountant and paying a large tax obligation because you needed to show documented income, now you needed to show 80, 100,000 income maybe to do what you're trying to do. Well, the tax obligation on that might be $40,000, might be $60,000.
Right.
So now to show that income to qualify for the loan, to get that, perfect Fannie Mae, Freddie Mac loan, that might cost you, say, $40,000 this year in federal income taxes, state and income taxes. So instead of paying $40,000 in taxes, it's possible to do what we call a bank statement loan, which, because you're not showing, your income flowing through your taxes perfectly, the interest rate might be higher than it would have been on a normal type of loan.
Got it.
But you might be paying another $200 a month, $300 a month in your mortgage payment. When people hear that initially, it's like, oh my goodness, that could be $3,600 a year more I'm paying for the house. That's horrible. Why would I want to pay another $3,600 for the house? But then if you back up and zoom out on the overall situation and realize, wait a minute, I can continue to zero out my taxes, not have a $40,000 to $60,000 tax obligation.
Right.
Yeah, I might have paid another $3,600 in your mortgage payments for the house, but your net, 30.
Right.
30,
yeah. If the trade-off,
$6,400 positive.
the trade-off. Would you rather pay the taxes or would you rather pay a little bit more in interest payment?
That's exactly right. And that
and
allows,
when you start comparing the two, that number is not even close.
Yeah, it's a no-brainer. So it's like, wait a minute,
Right.
I don't need to, save up $40,000 to send in on my federal income taxes.
Right.
I can get in the house right now. Like, there are a lot of options that people are not aware of that will allow you to proceed on a house without having to break the bank, without having to rewrite how you file your taxes, without having to do a lot of the things that people expect you would have had to do.
I want to talk about the local lender advantage thing. In Raleigh, we're competitive market-wise, right? We extraordinarily multiple offers can be common. Why does an approval letter from a local lender like TowneBank hold more weight with a seller than a letter from, say, a big national online lender? I am the fantastic online lender.com. But does it actually help get the offer accepted?
It really does. And here's some examples of how your pre-approval or type of pre-approval and the institution it comes from makes a difference. In the environment we're in now, it's more of a balanced market. Houses are staying on the market a little bit longer.
Right.
The average time to market, let's say, is 3-4 months compared to just 4 or 5 days a couple years ago.
Right.
Now you as a family are looking forward to your dream home, which you might have started to build 6 months ago, which might have started to be built 6 months ago. Or you're now in that phase where you're looking for where you want to go. Many people want to take a portion of the equity from their current home and use that towards their next home, or need to sell the current home they're in before they can move on to their next home. Maybe for qualification purposes, maybe they, need to move that equity from their other house to their new house. For whatever reason, you might want to do that. Now, if they're looking to, they have an exit plan and a time to do that, they need to be out of that house. So if they're listing and selling their house and they know they have to be out of it by a certain date, do you want to chance the people buying your house, their loan falls through or it drags out and you're not able to get rid of your existing house, which means you can't get into your next house? Or do you want to pick someone who has got, instead of just a pre-approval, maybe they have a loan commitment. Maybe instead of someone just looking at a couple of pay stubs and a bank statement, maybe someone that's taken their information and taken that borrower all the way through underwriting.
Right.
So we know, other than really divine intervention or something else stepping in, that this borrower is going to be able to move ahead on that purchase without any hiccups or unknowns or obligations. So the actual question is, why with certain lenders would it be better? Well, TowneBank, we're entrenched here in this footprint. We have physical branches. Our names are on the side of the stadiums, and our goal is to be a positive presence in this market. And TowneBank isn't willing to allow their name to get dragged through the mud. We have skin in the game. So when someone comes to TowneBank and we commit to them that we're going to close their loan on a certain date, we're going to do that. And we're going to do everything up front to make sure that happens. And we understand how important it is when someone feels like they're expecting to close and have keys to that house on a Friday. It's not that big of a deal. What if you just closed on Monday instead of Friday? from a corporate perspective, that doesn't sound like a big deal. But when you're buying or selling a house, you know how much is going into that. All the people you have helping you move your stuff. You have movers, you have people come, service providers that are going to be hooking things up. I'm sure there's usually a couple little things that are getting done around the house. There's all this stuff going on, and that's all coordinated to a time and a date. And if you move that, it is so difficult to re-coordinate all that stuff. The movers might not be available on the other date. You might not be able to take off work on the other date. You might have a work trip. There's all these things that make it really difficult to change the date, or definitely frowned upon to move the date of a closing. And having a lender who has skin in the game, who's willing to use their lending authority to make sure you close on that day no matter what, it's just it makes a difference. And at the same time, if you're choosing the offer to accept on a house you're selling, do you want to choose one that you know is 99.9% sure it's closing on time and in good shape? Or do you want to pick the other one, which is a little bit of a risk involved, or something that you have no control over, access to? So it absolutely, in our footprint, makes a big difference to be going in to battle, making an offer with a lender that's local, and everybody in the transaction, the listing agent, everybody knows that, oh, wow, if you're working with someone quality like TowneBank, you're going to have a good experience. It's going to work out well.
Well, and I think the big thing is, as a buyer, the pre-approval versus a pre-qual
versus a loan commitment.
This is a loan commitment is such a big deal. And I don't think people understand the power of that, because there's power, because it's a really powerful, it's a subtly powerful tool that I don't think we give enough credit to. So that when a buyer walks into the door, and let's say you're in a multiple offer situation, and the seller's looking at multiple offers coming in, and this person's is not just pre-qualified, this is pre-approved.
Or they have a loan commitment.
Or they got the loan commitment, which is even more powerful, right?
Yeah. Within the last couple of months, I can show you situations where the best houses available at any given time go first. If we have a shortage of houses out there, the best house at the lowest price is the first one to sell. And when that really nice house in really great shape at a really great price hits the market, you're going to have multiple offers on that. And if you were the one selling that house, would you want to choose the person who has the loan commitment and can close in as little as 2 weeks, and their personal stuff, their credit, their income, their assets has already been underwritten and approved? The only thing outstanding for the house to transfer to the new buyer is just basically the appraisal and the title related items. Do you want to choose that situation where you know you can close in 2 weeks and the borrower's already been underwritten? Or do you want to choose the situation where the person has a big box internet pre-qual that may or may not get done in 30, 45, 60 days?
Yeah, if you want safety and security, you're going the other way.
It's also a way as a buyer to make your offer stand out above your peers and get a home, win the bid on a home at a similar price to someone else. It's a great way for your offer to stand out and to get to the top of the list.
It's a big negotiating tool that we underestimate. I want to get to the fixer-upper loophole. When inventories, our inventory fluxes all the time, right? We're low, we got extra. I mean, it seems like we're somewhere kind of balanced. And sometimes the only houses that are available are, for lack of a better term, ugly or need work.
Yeah, need some renovation.
Does TowneBank offer renovation loans and let me buy the house, borrow the money, fix up the kitchen in all-in-one mortgage? Or
they absolutely do. So there are multiple types of renovation loans, all of which TowneBank offers. In addition to that, there are construction loans to do more than just a small renovation. If you want to gut the house and start over, that's an option too. So absolutely, there are options to do that. And that allows you to get into the house and use loan money
Mm.
to finance the renovations, as opposed to get into the house and then have to do all of those renovations out of your checkbook. So using our earlier example, a $400,000 house with 20% down, say they wanted to go that route, and now the house needs another $60,000, $80,000 to freshen up the kitchen, the bathroom, some other things. Instead of doing that, you can finance that in all the way up to, roughly 95%, 96.5%. You can finance the purchase and the renovations up to about the 96.5% loan to value, and end up in the house without depleting or deploying all of your saved money.
Right. So you still gonna have some money. You could keep your own money and work. That's pretty cool. As we wrap up here, all right, you've helped hundreds of people in your career. Is there a specific story that comes to mind, maybe that you think about, that there was no way that this person could buy a house, and then you helped them find a path? And what was their key to their success to help them do that?
Yeah. That one's super easy to answer. And why I say that is every single month. So I've been doing this I think I need to update my bio on the website, because I've been doing this over 25 years.
Right. When you started when you were 13, because you can't, because okay, fine.
Every single month I have a customer that sits down at the closing table and gets keys to likely their first house.
Mm-hmm.
And whether it was 6 months ago, a year ago, 2 years ago, or 3 years ago, they were just not a candidate. Every single month I have someone come to me that finally gets it financially, finally is ready to make the financial transition personally to figure out how to make it happen. And if they follow the lender's lead on how to manage and handle their credit, how to manage and handle their finances, if they follow that plan and truly are interested in getting over the finish line, making that happen, it works for them. So I have people that either had credit issues that needed help building their credit in the right direction to make it happen to get in the house. And I have people who financially have to redo their finances to either start to save money or just put their finances in a different situation to allow them to make that happen. I have people following that. And every single month I have someone who didn't think buying a home was an option, crossing that finish line, getting keys and being into a house. And that, I must say, that is a really, really good feeling.
It's fulfilling, isn't it?
Absolutely.
And right. I mean, it makes it feel like it's got to feel for you. I do this other show called A New Direction, and I talk about purpose, and in it, it does have to feel, when that happens, that more so than just, saying, okay, I do mortgages and help people out. There's got to be a sense of purpose in that says I've really given somebody an opportunity they didn't have before to achieve a dream that they only thought was just a dream, and made it a reality.
You're nailing it. And that comes back to a much bigger thing, love and gratitude. It brings those feelings into it. Like it's nice to be able to have a career, a job, call it what you want, and also get some of that gratitude and those good feelings out of it. You're 100% right. And those are the transactions that absolutely feel the best. Like you can feel it when you're at a closing, and that couple or the person is just vibrating at the table, so excited they just can't wait to get out of there and walk into their house. That you really did. You changed the path of that person's life a bit, in a way, and in a positive direction. And it's a wonderful feeling being able to contribute to that.
This has been a lot of fun.
Thank you, Jay.
We've done it. We've done. Actually, this is one of the best shows that we've ever done. We've always done good shows, but this is one of the best shows that we've ever done together. Tell people how they can get a hold of you out there, and so that because there may be people who are saying, you know what, Chris, I I would really like to get started on this path. My credit hasn't been good. I'm not sure how to get it going. You seem like a guy I could go to and help me get this thing straightened out. How they get a hold of you?
It's really simple. I'm a little bit old school. I still answer the phone, and that's the best way to get a hold of me. To reach me, my number directly is 919 area code 306-8895. Again, my name is Christopher Coy with TowneBank, and I'm not a hard individual to get a hold of or find information of online. You just do a search for Christopher Coy, TowneBank. Sure, you'll get led right to the portal where you can get things started. But the best way is to give me a call. I'd love to have a conversation with you and hear what's important to you, what you're trying to do, and hopefully and likely I'd be able to give you a little value on how to move it in that direction and get on the path to what you're trying to do.
919-306-8895.
8895. Yep.
919-306-8895. See, we did that in stereo. So if you're listening to us on headphones, you just got that in stereo for you. Thanks, Chris. It's been fun. Stay with me. Folks, this is the show. You know what I say to you. You have a lot of choices. You chose us. Thank you for doing that. Please give us a thumbs up on YouTube. If you're wherever you're listening to us by podcast, give us a 5-star review and tell your friends. That helps us a great deal, letting them know that we're giving out great information. If you have suggestions for the show, please reach out to me at jay@lindacraft.com. That's JAY at LINDACRAFT.com. We're always willing to hear your suggestions, comments, criticisms. I can take it. I promise you I can. As I say to you all over the world, you know what that is? Ciao, everybody.